Hello, everybody, and welcome back to Friday Fundamentals for Startups. This is our first event in the spring series after a long break, and we're happy to be back. We're also really looking forward to welcoming you all back in person pretty soon. Feels like we're getting close, and we can't wait to have everybody in Flu Call for events like these in the medium-ish future. Anyway, I'm Brady Ryan. I'm the manager of CoMotion Labs Hardware Incubator. CoMotion Labs is a multidisciplinary incubator program at the University of Washington, and we work with startups from both inside and outside of the university. We have spaces focused on software, biotech, and hardware, and we really like working with great founders. So reach out if you're a founder, investor, consultant, etc., who wants to get involved. We love meeting new people. While we wait for everyone to join this meeting, I'll make a few quick announcements. Next week, Nisi Hilton, sales communication and training consultant at Atelier, will discuss building trust during COVID, how to quickly connect and engage with primary stakeholders. For our full schedule and to register for future fundamentals, please visit comotion.uw.edu/events. Also subscribe on our YouTube channel and click the bell. Fundamentals for Startups is funded in part by a grant from the Economic Development Agency. We will be dropping a link in the chat to a short survey. Please, please, please tell us who you are and where you're from. That really helps us with our reporting so that they keep giving us money to do this. And finally, CoMotion is hosting a virtual startup career and internship fair on April 21st. There's no fee for employers to participate. And whether you're looking for your next great hire or just collecting resumes for future positions, register at bit.ly/CoMotion Career Fair. This year, we're also proud to partner with Bluetooth to support the Fundamentals for Startups program. See how Bluetooth audio sharing is poised to once again change the way you will experience audio and connect with the world around you.
Bluetooth introduced the world to wireless audio. Calling, listening, watching, making us safer, more productive, more joyful. It's part of the fabric of our lives. Now, Bluetooth will bring us even closer to each other and our world with audio sharing. It will let us share with others our music, our experiences, listening and watching together. The places we go will share with us, enriching our experiences, helping us hear our world. Breaking down barriers between interests, cultures, generations. Introducing Bluetooth audio sharing. Closer together.
Today, Gilad Berenstein is here to present board directors and corporate advisors. Why, who, when, and how. Gilad is an Israeli-born entrepreneur based in Seattle. He began his entrepreneurial career early while at the UW, and he was involved in several startups, including serving as the VP of Business Development at Watch to Help, a social cause marketing platform company. After college, Gilad was a consultant at PwC prior to founding Utrip, an artificial intelligence startup that he led for 7 years as CEO. Gilad was honored by Focusrite and named to their class of 35 under 35, and was awarded GeekWire's Seattle Young Entrepreneur of the Year award, and is a frequent keynote speaker at major industry conferences. Throughout the time, Gilad was also a board member and advisor to numerous companies, including Vibi, Spree, and others. Today, Gilad leads Brook Bay Capital, a small fund doing early-stage venture investing. In addition, he serves on the board of directors at Virtuoso, the world's preeminent luxury travel network, and several other businesses that focus on utilizing smart technology to delight customers. He is also a board director and corporate advisor to numerous technology startups and large ventures adopting AI or personalization in the US, Israel, UK, Australia, and others. He's a proud startup advisor and CEO mentor through a number of leading incubators and accelerators in the US and beyond. Gilad will take questions via chat. Please feel free to ask questions during the presentation, and I will now turn the event over to Gilad.
Thank you very much, Brady. It is great to be here with all of you. I wish we could do it in person, but next time we definitely will. So as Brady said, my name is Gilad Berenstein. It's a great opportunity to be here with all of you. And I'm going to jump straight in and talk about boards, directors, and advisors. So before I get into the main content, I wanted to tell you just a tiny bit about myself beyond the bio that Brady just shared. My name is Gilad, as he said. I grew up in Israel and moved to the States as a teenager. I went to the University of Washington, both for undergrad and graduate school. I'm a technologist, corporate director, and a founder and entrepreneur. Today, I'm going to share a lot of stuff that you probably already know, but my hope is that I'm going to put it together in a way that's going to give you deeper insights and perspective about the way to maximize the boards you work with or to structure boards if you don't have them already. And I would love to answer any questions you have either in real time or afterwards. So to jump in, we're going to start by talking about types of boards. Then we're going to talk about why we have boards, who should serve on boards, when to set them up, and then all sorts of details at the end about making the best use of your board. So jumping in, there are several types of boards, or there are actually many types of boards, and we're going to focus on the top three on this list today. Corporate boards of directors are the boards that we hear about most of the time, especially when focused on large companies or startups. There are other types of boards, I'll touch on those briefly, and then advisory boards, which are critical, which I'll spend most of our time today talking about. There's three other types of boards I'm not going to touch on today, but I wanted to make sure to mention them because these are likely things you would have heard of already. Things like oversight boards, special purpose boards, and of course, nonprofit boards. So to jump in, first, we're going to start with the why. Ultimately, boards of directors are very important for the operation of the company. And the first reason ultimately we have them is because they're legally mandated. Every state in the United States, and I believe most jurisdictions around the world, require for a corporation to have a board of directors. And that is legally mandated, and that's where we ultimately start. Now, I wanted to clear up any potential confusion about a few different titles that I'll be discussing today as we talk about boards, right? The three most common titles are CEO, corporate president, and chairman of the board. And ultimately, the distinction between them is fine, but it is important to understand. And one of the reasons this can be confusing, of course, is in many companies, especially startups, you often have one person serving as all three of these roles. So first we have the role of the CEO, and the CEO, of course, is an employee of the company. And the CEO's job is to manage employees, operations, and strategy from day to day to big picture. The second role is that of a corporate president. A corporate president and the other officers are legal representatives of the corporation to the state or the government within which jurisdiction you're doing business. And third is chairman or chairperson of the board. And the chairperson is a governance role, and they're responsible for the shareholders and stakeholders of the company. While each of these roles is distinct, as I mentioned, they're often held by the same person, but they are distinct and specifically distinct within the legal framework of the corporation. Alrighty, so jumping back in. The second reason to have a board of directors is the fiduciary duty. And fiduciary, I'm sure many of you have heard the term. It's essentially a fancy term that means responsible to stakeholders and shareholders. And ultimately, this duty is very important, and that's another reason why you host and have a board of directors. Third is for corporate governance. And ultimately, one of the things that board of directors is able to do is to offer an outside-in perspective to the corporation, which can help bring consistency and a big picture view to the corporate governance that sometimes can be hard for employees and other insiders in the company to be able to think about with the objective distance they need to have corporate governance really be general as opposed to specific to the situation you're in. And that's another important use of the board of directors. But ultimately, the most important reason to have a board of directors is not that it's legally mandated or for corporate governance, but it's ultimately because your board of directors is going to serve as your key strategy council and your brain trust. Ultimately, this is a really important responsibility. And what you want to do is you want to put together a group of experienced people from a diverse set of backgrounds and experiences to serve on your board of directors. These are people who are going to know your business intimately, but are going to be removed from the day-to-day operations of the business and the day-to-day challenges that you face as a CEO or as an executive team. They're going to engage deeply on strategy and helping you understand the market without engaging deeply in the day-to-day details of operating the business. They bring outside perspective and knowledge into the corporation and act as your brain trust. And the last thing I'll say about why this is such an important thing is the board of directors is the CEO's key support. It is often very difficult and lonely to be in the CEO chair, and your board of directors are the folks who are there with you day in and day out on the strategy level, on the big picture things that you need to think about as a CEO. Now, I thought that this quote right here did a really good job of explaining why boards of directors are so valuable. A diverse company's board changes the dynamics of the entire startup. It creates more equitable standards and lessens communication gaps. More importantly, it eliminates groupthink in the decision-making process because it brings together people who have different experiences. And that's why diversity of experiences is so important. Moving on, I'm going to talk briefly about the structure of a board of directors. And everything I say here is dependent on your business. So every business is going to treat this a little bit differently. But in a big picture, most boards are going to have 3, 5, 7, or 9 members. And potentially, once you get to a large public company board, could be a little bit bigger than those 9 members. Ultimately, when you start, and many of the startups that you guys probably have are going to be small, early stage companies. And your boards, I recommend to have 3 people on the boards. The 2 founders or the 2 initial people who are working on the project, along with 1 outsider or 1 early investor on the board. Someone who can help you think through the really, really early day challenges and opportunities that you have as a business. And even though the topic of today's conversation is not fundraising, the one point I'll make really, really briefly about that is that choosing the right investor is a really big deal beyond the funding that they can bring to your company, because these investors are going to be with you as advisors, as board members and stakeholders for the long term. So being picky, I think, is a very smart thing to do, especially at the beginning. Next, as your company grows a little bit, you will probably go from a 3-member board to a 5-member board. Very commonly, this happens around the Series A, when you're bringing in the first large institution or medium institution who's going to join your board. At this point, I typically recommend to have 2 founders, 2 investors, and 1 outsider. And I'll get back in a second to talking about outsiders and the type of people you may want to choose as an outside board member. Moving forward, at some point, your board will grow from 5 to 7. Here again, I recommend 2 founders, 2 to 3 investors, and 2 outsiders, even though as the board gets bigger, you do have more flexibility into the people you put on the board. One of the things I noted here on the slide as well is that this is where often it makes sense to bring key executives onto the board, even if they're not co-founder. But if they're now key investors or helping you think about strategy and growth of the business, there may be a good case to make for adding them as a board member as well. And lastly, once you get pretty big, usually IPO stage or sometimes even later than that, you're going to get to a board of 9 or 11 or 13 members. And here, what you're typically going to have is 2 or 3 insiders, founders or key executives, 3 or 4 investors, probably 1 representing each of the main equity holders in your business, representing a class of shares or an institutional holder. And then you're going to have 2 or 3 outsiders who focus on different areas of the business or bring different experiences to the company. Now, ultimately, outside board members are incredibly important. And the whole point of outside board members is to have someone who is not in the day-to-day details, but also does not have a huge personal stake in the business. They're not an executive, they're not a team member, they're not a large shareholder. There is someone who's able to bring a level perspective that is not in any way biased by personal interest or desire that would be understandable from an executive or a large shareholder. So a few folks you may want to consider as you bring on outside board members include industry experts. And there's all sorts of different types of industry experts, so it depends on your business and where your needs of the business are. A technical or a critical subject matter expert. For example, if you have unique technology needs or unique go-to-market or unique marketing needs, this would be a great place to bring in a board member with that kind of experience. Or a complementary CEO or founder, someone who's founded in your industry who can provide support to both the CEO and the rest of the executive teams in order to do that. So these are the types of folks that you would recruit as outside board members to join your board. Additional participants you may have join the board meetings but are not formally going to be board members are folks like board observers. So board observers can be small but strategic investors who are not big enough to have their own seat on the board, but you still value their insight and input in board conversation. This could be a way to elevate your advisors, and we'll talk a lot more about advisors in a minute, But this is a way to potentially take one of your most critical advisors and give them a bigger role and a bigger platform within the company by making them a board observer as well. Or this can also be a key strategic partner, whether it's a really important early client or a potential vendor that's very important for the growth of your business, and someone whose voice is going to be really valuable on those conversations. Those are the type of folks that you can bring in as a board observer. The only real difference between a board observer and a board member most of the time is that the board observer has no vote. So the members we talked about before, the 3, 5, 7 members will each have a vote. As I'm sure you all know, the board does not vote based on equity. One board seat equals 1 vote. And the board observer will have all the same rights for information and discussion, but will not have the vote. Another set of people you may include in your board meetings are key executives, your chief financial officer, your lawyer, your chief of staff, your COO, other people who are critical to both the operation of the business, but also may have insight for the board for the question they ask that you as a CEO may not have, especially once the business grows a little bit bigger and you no longer have the ability to really understand every part of the business intimately. They make really good additions to board meetings. And lastly are guests. And there's all sorts of folks you might have as guests at the board meetings. This can, again, be members of the team who want to have a perspective. This can be an advisor who you want to have there for one time. And also, this is a great way to try out potential board members. Some of the boards that I've been on, I first was invited as a guest to 1 or 2 meetings to share opinion, perspective, and insight. And based on those conversations, was then invited to join the board formally after that. And the last thing I'd say here is less is more. Ultimately, we don't want to have so many people on the board that it makes conversation tough, right? The goal of a board meeting, I'll say more about this in a second, is to have robust, thoughtful conversation. Obviously, very difficult to do that with a board of 30 people. So still be mindful, even though there's all sorts of valuable people who could be a part of the conversation, be mindful about who is really critical at which stage and make sure that those are the permanent members and other folks are brought there as guests. Now, ultimately, the next question is, when do you set up a corporate board? The answer is now. Business is a team sport. Business is not a sport that we play by ourselves. So if you are building a business, now is probably a great time to put together a corporate board if you don't have one. And if you have one, this is a good time to think about, are there other people, whether it's an outside board member or an observer, who would make the conversations more robust, would make the insights more valuable? Those are the types of folks that you might want to begin recruiting and talking to right now. The next point beyond cadence is beyond when is the cadence of the board meetings. And ultimately this changes based on the stage of the business. So if we start with really early stage companies where I'm sure many of your businesses are today, where you're still seeking that product market fit, you're still playing with the product and the market and the marketing to try to find your initial product market fit, I typically recommend 6 annual board meetings, so every other month. This is a little bit more frequent than boards typically meet with larger companies, but ultimately there's a lot of stuff changing, a lot of data coming in all the time that is really important for your brain trust to be able to talk on a regular basis. Another reason why in early stage startups you meet more often is because you probably have not yet filled out your executive team. It's probably a couple founders, maybe a couple early team members that you're working with, but you don't yet have a full complement of seasoned executives. And this is one place where both board directors and advisors to your company can play a really critical role in helping you backfill until you have the funding and the ability to bring on those additional executives. As your company continues to grow and you reach this is still startup stage, this is mid-startup stage. So you're beginning to scale your company, you're beginning to invest more heavily in sales and marketing. Typically companies here move from 6 annual meetings to 4 or 5 annual meetings. You still want to be talking pretty frequently, but the data is not coming in quite as quickly. And you probably have hired a couple more key team members at this point that are helping you manage day-to-day strategy. And then ultimately, in perpetuity, you're going to go to 4 annual meetings per year. Every board meets at least 4 times per year. And I find that that's really the minimum cadence you can have to make sure that your board members are kept up to date and you get their perspective on it in a timely manner. The last thing I'll add about cadence is not every board does this, but I'm a big fan of special purpose meetings. Ultimately, at a board meeting, you're typically going to have a set agenda, and I'll talk a little bit more about that in a second. And one piece of advice I'm going to give you is that you want to keep the agenda very, very consistent across your meetings. You don't want to be changing agenda very often, which goes into intellectual honesty and transparency. And ultimately, sometimes there's topics that you want to discuss in more detail with the board, whether it's go to market, whether it's a new customer vertical, a new geography, whatever it may be. I find that these are best done during special purpose meetings where you can invite the board member to focus on one topic outside of the normal cadence of meetings per year. And you can also be a little bit more liberal about inviting additional people who you probably would not invite to your formal board of directors meetings. Next, I just very briefly want to talk about the unique role that the board of directors plays. And this is really different from any sort of leadership council, leadership team, advisory board that you may set up. There's a few things that are really uniquely suited to the board of directors. First is any decision that comes around equity, debt, or financing of the business. These are strictly decisions to be made by the board of directors. These are some of the times the board of directors will formally take a vote on things. So this is purely in the purview of the board of directors and one of the key things that they need to be deciding on and informed about. Next is CEO evaluation. Of course, the CEO reports to the board of directors and reports to the chairman of the board. And it's important for the board to provide evaluations to the CEOs. Now, ultimately, this can be challenging because I'm sure in many of your boards, like in many of my early stage boards, you are both the CEO and the chairman of the company. And this is where you utilize your other board members. And if you're really early, it's maybe your investor, your outside board member, to give you as a CEO an evaluation, an outside-in perspective on what are some of the things you're doing very well, what are some things you should be focusing on. And I find that helps the CEOs tremendously, as they're trying to improve their own skills and improve their own performance over time. Next is the board of directors responsible for executive hire and compensation, another piece that's very important and of course rolls up into the board of directors. Next are major capital expenditures. So essentially any sort of very large decision going to make impacting the capital the company has raised either through equity or debt is typically something you're going to want to get the board's blessing on. And if it's really big, even potentially a formal vote and resolution of the board of directors. Corporate governance, I mentioned this briefly at the beginning. This is very important, bylaws and other elements that go into corporate governance. This is not something you're going to be looking at regularly, especially if your business is doing well. But this, of course, rolls up into the board of directors, and from there will be filed with the states. And lastly, macro, the highest level strategy, and of course, mergers and acquisitions are going to be things that are the purview of the board of directors. And a few more topics about board of directors here, best practices. So ultimately, how do you actually make the most of your board, and how do you make sure the company is getting great value from the board members you have on board? First, you have to have a pre-read. The goal of a board meeting should not be an update or a catch-up session. The goal of a board meeting should be a working meeting where the board can actually add value to the company, whether it's advice, decisions, perspectives, etc. In order for board meetings to be effective, there has to be a pre-read, and it has to be something that's sent out enough in advance that your board has a reasonable period of time to actually read the material and come to the board meeting prepared. I think that if you only take one thing away from this section about best practices, it's you should have a pre-read for your board. Have them come into the meeting prepared. Next is intermediate one-on-one calls. When I'm CEO and chairman of the board, I try to have at least one call with each board member between the formal board meetings to make sure that they're up to date and they feel included in key decisions, to answer any specific questions that they have that can be answered before the board meeting and before you have to go to any sort of more complex, larger conversations. You can answer those questions up front. Another reason is to get their take on key priorities. Essentially, what should be on the agenda for the next meeting? What do they think that you should be discussing with the board at your upcoming meeting? And lastly, sorry, I'm not skipping the slides here. I'm skipping ahead too fast. I got excited about the next slide. But the last thing I'll say before I go to the next slide is the whole point here is to reduce the chance of surprises at your board meeting. Ultimately, if someone's going to bring up a resolution, conflict, a concern, whatever it is incredibly helpful for you as the CEO and for the chairman of the board to be well aware of that. So that's some of the value of intermediate calls. Next, which is what I was so excited to talk to you about, is scorecard and debt consistency. And I referenced this just a minute ago. Ultimately, one of the goals of any good functioning board is to have intellectual honesty within the boards, meaning that we're not changing the metric we measure, we're not changing the scorecard between meetings. If things don't go well, we as optimistic humans and founders have an innate desire that comes from a good place to focus on what's going well, to focus on the metrics that are most exciting. but that actually leads to bad outcomes for the company. So one of the things I often recommend is have a consistent scorecard. The same set of KPIs you measure every single month and you report to the board at every single meeting so they can see the change of those consistent KPIs over time. And similarly with the agenda and the debt consistency, the more consistent it is, the more honest your board can keep you and the more involved they can be and see how things are going well and what things are not going well. Next is voting. And of course I put here no voting. With the exception of when you're approving equity, debt, or M&A or things like that, which hopefully are not happening on too frequent of a basis for your company, is there really shouldn't be a lot of voting. There should not be a lot of resolutions. And I've often mentored CEOs to whom I'm an advisor or a board member to say, if your board is voting regularly, it probably means something is not going well. Either the business is not going well, the mix of members on the board is not going well, and the relationship with the CEO is not going well. So ultimately, you should be building consensus on almost everything without it ever needing to come to a vote, especially a vote that's contentious in any way. And lastly, ultimately, board bonding and board cohesion is incredibly important. The ability for the members of the board to be open, to be transparent, to be vulnerable with each other is what leads to boards being effective or ineffective. So ultimately, I think board cohesion is really important. We do this via dinners, via events, via one-on-one meetings with board members that do not include the CEO and the operators of the company. But whatever you can do to build that bond between your board members, between your directors, will lead to a better functioning board and better outcomes for the company. All right, so I said a fair amount about boards of directors, and Brady will interject here if there's any pressing questions. But the next category I'm going to talk about very, very briefly are other corporate boards and committees. Typically, we're going to see these with larger companies. So these are not something that I expect most of your startups already have. And it's not something I'm recommending for most of your startups to form now. I think with all of these, you form them when needed as your business is scaling and growing. So some of the types of boards and committees I'm talking about here are non-fiduciary boards. You see this most frequently with privately held companies or even single shareholder companies, where there's a single shareholder that owns the entire business or almost the entire business and thus decides not to formally create a fiduciary board. You know, they may have a board of one for state purposes, for legal purposes, and they may create a non-fiduciary board, which is essentially like an advisory board, but typically for a business that doesn't have a formal board of directors. Another very common committee is the Audit Committee. Every public company has one of these, but many non-public companies have them as well. If you're raising large amounts of capital, especially if parts of it is debt capital as opposed to just venture or other types of growth capital, they would often ask you to form an audit committee, a part of the board of directors or a separate committee altogether to be looking at your audit and making sure that everything is above board. You also often hear about investment committees and investment boards. These are companies that are more actively spending capital, either investing in other businesses or more frequently businesses that are buying assets, whether it's real estate assets or building factories or any sort of expensive investments. There will often be an investment board or investment committee that reports either to the CEO or to the board of directors that reviews those on behalf of the company. Next are HR and governance committees. And not a lot to say there. This is really about getting into the details of governance. And this is typically really only had at very large companies. And lastly, our diversity and inclusion boards. This is something that's becoming more and more common these days. And we see that happening in companies large and small. So you'll probably come across these as well. And the last point I'll make about all of these types of boards and committees is that some of them have power, some of them have teeth, some of them have influence, and some of them have none. And ultimately for your business, since you're the CEO, I would ensure that any committee or board you set up has some power and has some influence in your company. And I would highly recommend to get rid of any boards and committees that you sense don't really have a purpose and don't really have any sort of teeth behind them. Next, I'm going to jump into our last main section here, which is the advisory board. The advisory board, I think, is of critical importance, and I hope we get an opportunity to talk about this in the Q&A as well. I think that for most startups, especially young startups, building an advisory board is one of the best things you can do as a founder to make sure that you have the support you need around the table in order to actually scale this business. So let's jump in and talk about boards, advisory boards, as well as advisors, and I'll touch a little bit about the difference in just one second. So always I like to start with the why. And the most important reason to set up an advisory board is for insights and knowledge. ultimately you need advice, because when you start a business, there's all sorts of things you need to do to get that business off the ground that is probably outside of your personal area of expertise. And of course, as we talked about, because you don't have a large executive team at first, it is probably outside the area of expertise of the core team members. So the first reason to have an advisory board is to be able to get the insight and knowledge of knowledgeable people from different experiences and backgrounds who can help you think about how to build and grow the business. Second, similar to your board of directors, is to get an outside-in perspective, right? Those of us who work on our own businesses and startups, we are so deep in the startup, we think about it all day, every day, that it's easy to miss the forest for the trees. And this is one of the things that an outside perspective can help you in. And like I mentioned, the last big reason here is to backfill any sort of executive shortages you have because you've not been able to hire a full executive team yet. Second reason to build an advisory board and to have advisors is to be able to access their network and their connections. Ultimately, no matter how great your network is always going to be limited. And the help to network, especially in the early days before you have a large sales team or recruiters or bankers, etc., is incredibly valuable to have the network and connections of your advisors. Next is brand and credibility. This is a really good signal to the world of the type of folks who are interested in supporting your business and believe in the mission you're working on. So this is really strong signal to investors, to potential clients, and to potential hires in your company to show that you have serious people with serious background who believe in this and are there to support you along the way. Next is negotiating chip. This is one of the less important reasons, but still valuable nonetheless. Ultimately, when negotiating with investors, sometimes they want to have a little bit more visibility into what's happening in the company. But for one of many reasons, you are not interested in inviting them onto your board of directors. This is a great way to get an investor off the finish line, to give them a little bit of extra access to the company, and for you to benefit from their insights and connections as well. Now, ultimately, you might be asking who, like what type of people should you be filling these advisory roles with? And similarly, outside board members, like we talked about before. So there's a number of categories of types of people. So these are going to be industry experts and insiders who understand the industry, the way that it works, the way that the seasonality or sales motion or different parts of the industry works. Another are knowledgeable investors. So like we talked about before, people who are investors that are not big enough to make it to your board of directors, but have valuable knowledge or insight that you want to benefit from. Third is key clients. And I'll repeat this a couple of times, so I think it's critically important. But having key clients on your board of directors is incredible, or sorry, your board of advisors is incredibly valuable. They're going to give you the most honest perspective on what the challenges your product has in selling, both in the fundamentals of the product and as well as in the way that you message that product. So I find that key clients are a great addition to your advisory group. Subject matter experts and technological experts or technical experts are also the types of folks you want to bring on, especially if there's some sort of very complex type of technology or something that your business is dealing with. In terms of structure, there's really two main questions to think about this. The first question is board versus group. And the main thing I mean when I say that is, are you hoping to also benefit from this collective as a board, meaning to also benefit from the value of having everyone together in one set of conversations on a semi-regular basis and benefit from the wisdom of the group, as opposed to just having a group of advisors who you mostly interact with one-on-one on an as-needed basis? And I don't think there's necessarily a right or wrong answer here. I think this depends on both the stage of business you're at and the type of business you're at. But that's one of the questions for you to think about as you're structuring your advisory board. And second is to think about whether or not you want to do this as one group or one board or as multiple boards. And ultimately for me, as you grow, again, everything should be as you scale. None of this is stuff that you should be doing upfront before you're ready for it. But I found a lot of value in having multiple advisory groups or multiple advisory boards, especially when you're big enough you can have some staff assistance in managing this. You're not managing all of these yourselves. But essentially, some of the examples of groups that I've had before are things like your corporate advisory board, the main type of advisory board we're talking about right now. Client advisory board, where you can actually bring multiple clients and have conversations about the market and the marketing and the messaging directly with them. User advisory boards, these are incredibly important, especially if you have a product that is used by an end user, by an end consumer. Incredibly valuable to have insights from that, as well as industry counsel. So this could be other people in your industry who are not necessarily users or clients of your product, but are playing with it in the ecosystem, and getting their perspective on how to do things is also very, very valuable. When, just like I said before, right away, but also just like I said before, start small and only add advisors as needed. The goal here is not to have a laundry list of advisors, but the goal is to have a small number of advisors who are actually engaged with you and actually providing value to you as the founder and to your company. In terms of cadence, ultimately, if you're going to have a board or a group meeting with all of your advisors, I recommend doing it once or twice per year. It's something that takes a fair amount of effort to put together a good advisory board meeting. And because it's typically bigger than a board of directors, it's also a little bit more effort to schedule it. So I find that once or twice a year is probably good for the group meetings. And then for individual advisors, I recommend that you meet with them on a regular basis during the period in which they're adding value. Meaning if you have a go-to-market advisor, you should be meeting with them probably a couple times a month as you are structuring, setting up, and testing your go-to-market, but probably something you can pull back on as the business is growing and as the go-to-market is succeeding. Next, a few other considerations of things to think about when you think about your board of advisors. First is, do you want to give the board of advisors a narrow or a broad mandate? Of course, as we talked about before, the board of directors has a relatively broad mandate because they touch all things relating to equity or debt or things like that. With the board of advisors, it's really your choice as the founder and as the entrepreneur to decide what the mandate is. And I think there's pros and cons to both. Ultimately, a broad mandate means that they're going to understand bigger parts of your business and be able to give you advice on things that you may not actively solicit or ask for. Whereas on the other hand, by having a narrow narrow mandate, a narrow focus, you're able to go much deeper with a given advisor or set of advisor on a specific problem. So I don't think there's one right or wrong answer here. It just depends on what your business needs. But that's one of the questions for you to think about when you do that. Another thing to think about is essentially short-term versus permanent, which I touched on briefly a second ago. There are such needs that are temporary or short-term in nature. For example, go-to-market for a very early-stage company is going to look very different than your market growth efforts you're going to have a couple years in. So some of these advisors might make perfect sense to be short-term advisors. Similarly, if you're bringing on other founders who have a lot of experience in the very early stage part of the journey, you might want to bring them on as short-term advisors for a year or two. Versus some permanent advisors who may be people who understand the inside and outs of your industry, key technology advisors, or other folks like that. Next, we have terms investing, which also relates to short-term versus permanent. The next thing about the board of advisors is you don't have to have formal terms. And I typically use the vesting schedule as a de facto term for the board of advisors. And the reason I do that is because it actually makes it really easy at the end of the relationship or when the relationship is changing to not have to have any sort of uncomfortable conversations with the board of advisors. Whether it's you as the founder wanting to diversify and bring someone else to the board of advisors, by having a vesting term, you don't have to terminate that advisor. You just let the vesting period end. They keep their equity and you could bring someone in for the next term. And also for the advisor, if they choose to no longer participate for one of many various reasons, it gives them a natural off-ramp without having to have any sort of uncomfortable conversations. And obviously implied within this whole point is every one of your advisors and every one of your team members, including yourselves, should always be on a vesting schedule. And I'm happy to talk more about that in the Q&A. And then final section here, a few best practices for advisors. So overshare. Ultimately, it's very hard to give you thoughtful advice if the person giving the advice does not have a broad understanding of what's happening in the business and the things that you're working on. So overshare, send them pre-reads, send them the monthly scorecard you share with your board of directors. BCC them on relevant emails to make sure they're up to date, because that's how you're actually going to get the best advice from them by doing so. Second is set specific goals and objectives for each relationship. I find that if you don't, it's very easy to have a conversation that's enjoyable, that maybe has limited value in perspectives that they give you, but it's hard to maximize your value with having specific goals and objectives for each advisor relationship. So, if you're having an advisor for go-to-market or product development or business development or tech or whatever, make sure you have specific goals and objectives for how you can maximize that relationship and make the most of that relationship. And also, I would just say real quick as well, is that it's your job as the entrepreneur to optimize the relationship. It's not the advisor's job to optimize it. So it's your job to come prepared for each of these meetings, which of course brings me to the next point here, which is prepare and ask. For every meeting, there should be a specific ask. I want your input on this. I need your help connecting with these types of people. Have a specific ask, and I find that really helps you maximize the value that your company gets. Lastly here, another best practice is customers and advisors. I told you I'd repeat this a couple times because I really believe this is valuable. This is critically important. This is both going to help you reputationally with product, with marketing. So definitely make sure, even if you don't do an entire client advisory board, they have at least 1 or 2 clients join you as advisors. Now, beyond advisory boards, as I conclude here, there's a few kind of general points and pieces of information I wanted to share. First is compensation for outside board members and advisors. Inside board members do not get compensation because you're an employee of the company. You already have equity as a part of being an employee of the company. And of course, VCs and other investors that are sitting on the board also have equity. So when we talk about directors, is really for the outside director and of course for all advisors. So ultimately what you see is that roughly at every round, you're going to drop by half, roughly, the amount of equity you grant to new advisors or board members who join you at that round. So for example, if you guys are really, really early, you haven't raised any capital, you're probably pre-revenue, then bringing a board member, you're probably going to give 3 to 5% equity up front, and an advisor somewhere between 1 and 2.5%. And as you see, it goes down in every single round from there. And these are all, of course, on a vesting period, like I mentioned. So if the relationship does not work out, you will get most of your equity back. Lastly, once you get to a later stage company, Series C, Series D, and certainly as you get closer to IPO and public markets, you're usually going to go to some version of cash and equity for directors. And typically you're going to have fewer advisors at the later stage and more consultants or advisors who are paid with cash. So really the equity piece is a little bit earlier in the process. And these things vary widely based on all sorts of things, including the size of the capital raise, how much money you raise. Obviously, if you raise a huge round, then there might be a faster reduction in the amount of equity you give up front. Similarly, if your valuations had a very large jump in valuation, that would impact the amount of equity you give downward, of course. The prestige of the member you're recruiting. If you're trying to recruit someone who is truly an icon in the industry, you will probably have to make a bigger offer. The industry you're in will make an impact. Traction to date will make an impact. And of course, your desired commitment. If you're asking for someone to become your CEO advisor and talk to you every week, you're obviously going to have to compensate them more than someone you might talk to regularly for a few months and then talk to irregularly in the future moving from there. Additionally, a few pieces of advice for well-functioning boards. So the first, well-functioning boards, as I already mentioned, have trust and respect amongst the members. I already spoke about that a little bit, so I won't go into too much detail, but this is critical. If your board members don't trust each other, the value of the board is going to be greatly diminished for the company. Next is intellectual honesty and openness. The idea here is that people feel comfortable being vulnerable with each other. People feel comfortable saying when their predictions or assessments did not turn out as predicted. And one of the things that helps with intellectual honesty is data consistency, the scorecard, the agenda that we talked about earlier. Next is a robust and open dialogue. Ultimately, you need these board meetings to be working meetings where people are talking and sharing, because the best value will come from the input that people have based on each other's conversation and feedback, as opposed to anything that happens in a vacuum with just a one-on-one conversation. Next, information transparency and consistency related to intellectual honesty, like I just mentioned. And then lastly, understanding of each other's circles of competence. Every one of us was asked to join as a board member or as an advisor because there's something that we have competence in, knowledge in. So remember why those people were brought in and make sure to try to tailor each person's contribution to the area where they have the most to add. Similar, in order to maximize the board's value, ensure that meetings have objectives. As I mentioned, they are not catch-ups, they're working meetings with specific objectives that you're trying to meet. Ensure that everyone is prepared with a pre-read, with financials, all the kind of things that board members or advisors will need before the conversation. Don't hoard the advice and expertise for yourself. Be generous with it with your team. Make sure that your team members have access to the feedback and advice you're getting from board members and from advisors, and vice versa. Make sure your board of directors is getting the feedback from your advisory board and the other way around as well. Recruit diverse members. I could spend a long time talking about this, but I think we all know this by now, that diversity leads to better business outcomes. So diversity is incredibly important here. And then, of course, include relevant team members when possible in the conversation. Ensure that they're able to get the value directly as opposed to having to go and get it secondhand. So this is the presentation. I look forward to answering some questions.
That was great, Elon. Thank you. I really liked the last thing. Meetings aren't catch-ups; they're working meetings. I think that's advice everybody can take. We have a couple meetings. One from Alex Hammerberg. She was asking, recently there seems to be a shift away from founders becoming executives. How often do founders also hold executive positions, especially in early/A stage startups?
So founders often hold key executive positions, but it depends on the changing of the business. And I often say that founders who are willing to understand where their strengths and weaknesses lie are often the best founders. So ultimately, founders scale or don't scale with the business, just like any other member of your team is going to scale or not scale with the business. So typically, you want to recruit founders who can be executives and can grow as the business's needs continue to grow. But there's nothing wrong with the fact that sometimes founders can't scale, and sometimes founders choose not to scale. They like the early stage better. One of my great mentors is an entrepreneur who has started many successful businesses, including a couple that ended up being unicorns. But he knows that his greatest skill set lies in the first 5 or 6 years of a startup. So he naturally takes himself out of the running for senior executive roles after that. So I think, you should try to find key founders who can grow with the business, but there's nothing wrong with the founder or with the business if other executives are brought in over time.
So that's something that I talk to founders about when they're fundraising or thinking about their path forward. Early stage CEOs are not always the CEO for the IPO. And so I love to hear that. So as an investor, you notice that, and you don't mind when somebody says, hey, I'm raising this seed or this Series A, and in 18 months, 2 years, whatever, I'm going to be the head of product or the head of something else. That's great to hear. I think a lot of folks think that they have to scale with their startup, and if they're the founder, they have to take it to IPO. So
they don't. And I also add one more thing, which is most people who found a company found it because they have a passion for the product or the service that company is providing. As your business grows, the CEO's job becomes further and further away from product and from the service you're actually offering. So it's very frequent that founders are just super passionate about the product and want to stay closer to the product, in whether it's a head of product, a head of strategy, or other types of roles like that.
Yeah. Great. Thank you for that. I really like the outsider board member role and how much you talked about that. That's something I've heard about, and I've not had that explained as well before. Can you tell us about when you brought on an outsider and kind of what that process was like? How did you find them? How did you court them? Kind of all of that.
Yeah, absolutely. So I brought in an outside board member, exactly what I recommend for you guys at the very beginning. So our initial board, so if we use my company, UChip, as an example, the two board members are myself and my co-founder. And then we brought on our first outside director. He was a serial entrepreneur who had started multiple startups. A couple of them had succeeded, a couple of them had failed. So we felt like he had a really interesting and diverse background of experiences to talk about, things that worked and things that didn't. We were connected to him by one of our angel investors as a potential person to just get coffee with and give us advice. And after that first conversation, I knew I wanted more of his advice. I knew I wanted more of his time. And we spent several months just, as I jokingly say, dating. We'd go for coffee, we'd talk about the business. I'd send him an email with a quick question or a thought. And after a few months, I realized that he would be the great partner. And then I just asked. I asked him if he'd be willing to join the board. I offered him equity. He pushed back and asked for some more equity. I thought that he was useful enough that he was worth it. So I said yes. So ultimately, that's how I recruited my outside board member. But I'll give another example. I often serve as the outside board member for other companies' boards. And very often I'm brought in either as an advisor first or as a guest. So one of the boards I serve on today, one of the larger boards I serve on today, I was invited as a guest to one meeting because they were talking about a topic around personalization, which is a topic I know a lot about. And after that one meeting, they asked me to become a board observer. And after a couple more meetings, they invited me to join the board fully. So that's essentially how that happened. And I think finding outside board members is critical. And many of you, as you build your own experience sets, will be approached about becoming outside board members, which I find to be a very enjoyable and rewarding experience.
So Violet asked a question somewhat similar to that. Let us know in the chat, Violet, if you feel like that's answered. If not, we'll circle back to it. One thing you mentioned, having key clients on advisory boards. What happens if they stop buying from you? I mean, is that a pretty clear signal that you're off the mark as a company? Does that get awkward?
Yes. I mean, I say ultimately in terms of the vesting period helps you there. So ultimately there is an off ramp both for the advisor and for you if things are not working out. But ultimately, having a client on your advisory board is incredibly valuable because they bring you the most brutal of honest feedback that's very hard for other people to give you if they are not a client type, if they don't live every single day in the shoes that your clients are living in. So ultimately, I find that feedback to be incredibly valuable. The other thing that's nice about having them as an advisor is typically they're going to give you more benefit of the doubt than a normal client. So it's also one of those things that if things are not going well, they're typically going to give you a lot more heads up and try to work with you on solving the problem much more so than a client who is not on the board of advisors would do. So I think that actually protects you a little bit. But the key point here is that no matter how smart and wonderful your directors and other advisors are, your clients are living in their own shoes every day, and they can provide you insight that's really, really invaluable.
So Bob Thong asked if you could elaborate on vesting. Can you kind of run us through how that works, vesting schedules?
Yep. So the most common vesting schedule you're probably seeing is a 4-year with a cliff. That is a very common vesting schedule. We usually give that to almost all of our employees at startups. I also think the founders should be on the same vesting schedule because honestly, if after a year the founder can't stay with the business, most likely should go back to the business anyways.
And real quick, we're talking about shares of equity vesting over time so that, you know, you're going to give somebody 1% of your company. They don't get it all up front. They have to work for it and get it over time.
That's exactly right. So if we use a 4-year with a cliff as an example, if you're giving someone 1%, they will own none of it until the 366th day of service, at which point they will pass the cliff. 25% of that will then be owned by them. If they leave or get fired or whatever, they still own that 25%. And then typically what happens is every month or every quarter for the remaining 3 years, either 1/12 or 1/36 of the remaining equity will essentially be vested that month. So then if you let them go after 2 years, they keep half the equity and the company gets half the equity back. With advisors, I typically don't do a 4-year vesting schedule for the reason we talked about before, which is in 4 years is a long time. Your needs as a business will likely change, and you may want to bring on new board members or new advisors within a 4-year window. So I typically recommend a 2-year vesting window for an advisor or a board member. I've also seen a 1-year. The problem with 1 year is 1 year goes by a lot faster than you think it's going to go by most of the time. So I recommend 1 or 2 years. I usually do not do a cliff for advisors or board members, but I have been put on a cliff myself, which I think is a totally reasonable thing, especially if the founders have put themselves on a cliff. Either way, everyone should be on a vesting schedule. And if someone needs to leave for one of many reasons, that gives the business the insurance that they can get that equity back. So they're going to recruit a new advisor or a new board member in their place.
And then from an investor's point of view, if you're in diligence with somebody and they don't have their board members or advisors or key early employees on a vesting schedule, is that a pretty good signal for you that there's...
If I'm interested, I will put them on a vesting schedule. I've never done this, but one of the things that funds sometimes do, even a slightly larger funds, will actually put the founders on a vesting schedule if they're not on one. And that's something you actually see happen pretty frequently. And they might not put you on a 4-year if you're already 3 years into the journey. They might not put you on a 4-year vesting schedule starting in year 3 or whatever. But yes, an investor that's coming in, specifically a lead investor for a seed or an A or a B round, one of the things they're going to look at after they decide to invest is your cap table. They're going to want to make sure that there's enough options in the pool so you can incentivize new advisors, new board members, and new team members to join you. They're going to want to make sure there's enough equity in the founder's hands still, especially if the founders had a lot of dilution up front, to make sure the founders still have a strong incentive to be at the business and perform. So ultimately, you want to keep your cap table clean because A, it can be a red flag or a yellow flag for a potential investor. And even if you still get past that, they might make you rework the cap table, which can be sometimes painful. So anyways, I think doing this clean up front is the right way to do it.
Sure. Laura asked, what about asking for an advisory board member but not offering compensation? Is that ever a fit?
I mean, the answer is probably, especially if it's an incredibly short-term advisory role, right? So I do this all the time where I call myself a mentor at that point instead of an advisor, right? If you're going to have 4 or 5 conversations with someone for a few months, I think there's perfectly, acceptable to have them be a mentor as opposed to an advisor, or even to make them a personal advisor to you as opposed to a corporate advisor to the company. Having said that, if they're providing real value in helping you build your business, then I think it's right for them to be compensated for that. And remembering that obviously the equity that you're giving them is still a highly uncertain asset, not only because most startups fail, as we all know, but also because lots of startups end up selling for a price that's not high enough for common options to be very valuable. So it's one of those things that you're often not giving them much, with the exception of those few companies that make it really, really big. So the short answer is yes, I'm sure there's appropriate times, but if they're adding real value, then I think compensating them is probably appropriate.
Sure. Violet checked back in. So I guess she's looking for, so she was the one who asked a question about kind of finding outside board members. And she was asking how to make that connection if they're completely outside of your network. I guess, is a LinkedIn cold reach out appropriate? Do you just have to pound the streets to get a third degree? Okay. Yeah,
always. I mean, the cold LinkedIn, I usually do not use it as my first attempt. Usually I try to get a warm introduction through someone else I know, often on LinkedIn. But yes, I think the cold introduction is always acceptable. And I was actually on a call last week, I think, with a group of large VCs down in Silicon Valley. And they were actually saying how, like, the chance of response to a cold LinkedIn reach out has gone up and up and up over the years for lots of reasons. But one of them is I think a lot of investors and executives are looking for greater diversity in their portfolios and the companies they support, et cetera. So I think people are actually quite open to a cold outreach, even though, of course, if you can get a warm introduction, it's better. And when I reach out to a potential board member or advisor, I always begin by just asking for a call to pick their brain about something, to get their advice or feedback about something before I ask them for any sort of formal commitment, because, you both got to know each other a little bit to make that relationship commitment that hopefully lasts at least a few years.
Yeah. And, you always hear about board membership being a marriage. How does divorce work? I mean, we know that maybe you can protect yourself with a vesting schedule for some folks, but if you have one of your big investors join your board and it's not a fit, or you can't create cohesion with the rest of the board, what are your options?
It can be horrible. I mean, it can be really bad, but most of the time it's not. The good news is most of the time it works out just fine, because if the relationship's not working out for one of you, there's a very good chance it's not working out for the other one also. So I think having those conversations up front is really important. And also that's the importance of board cohesion that I talked about, especially on the board of directors, but also on the advisory level. If you're the only person who feels this way, then I would push you to recheck your own gut feeling to make sure you're not feeling uncomfortable because of pushback or whatever. But often if there's consensus on the board that there's a member who's no longer the right fit, then the rest of the board can act as a very supportive way of helping you make that change. And with vesting, ultimately, I mean, obviously if you're just at the beginning, 3 months into a 2-year relationship, you probably don't want to wait, the remaining time. But, often if it's been a year and a half and it's a 2-year relationship and you want to bring someone else on, there's often an easy way for you to essentially off-ramp and on-ramp without having to have any sort of formal cutoff date or whatever. But ultimately, if it's not working out, it's almost always not working out for both parties. So you can just talk about it.
Sure. Well, there's no more questions that we've had there. I really want to thank you for your time. This has been a fantastically insightful presentation. I don't think we've done boards of directors before. So this was great. Thank you.
Thank you very much. It was great.
For everybody, thank you for joining. Again, big thank you for sharing your wisdom with the group. And as a reminder, next Friday at noon, we'll be hearing from Nisi Hilton, sales communications and training consultant, who will discuss building trust during COVID, how to quickly connect and engage with primary stakeholders. Sign up for that, and we'll see you all next week. Thanks so much.